Okay, so you've done all the hard work. You've researched, you've crunched the numbers, and you've finally found a company you really believe in. You're ready to pull the trigger and invest. But right when you open your brokerage app, you've got one last super important decision to make before you can actually hit that buy button. So, you've picked your stock. Now what? Well, what's next is figuring out how you're actually going to buy it. And yeah, it seems simple, right? But the way you place your order can have a real, tangible impact on your investment. This is that moment where your whole strategy finally meets action. And trust me, it's a little more complex than you might think. That's because the buy button isn't just a single button. It's more like an entire investor's toolkit. And just like any good toolkit, you've got different instruments for different jobs. Knowing exactly which tool to grab and when to use it is honestly the key to making your investment strategy work. So today, we're going to open up that kit and see what's inside. So our first tool, this is the most common and probably the most straightforward one in the box, the market order. Think of this as your tool for pure speed. You grab this one when your number one goal is just to own that stock as quickly as humanly possible. No waiting around. So what is a market order? It's basically you telling your broker, hey, get me into this stock right now at whatever the best price is on the market. The key word here is immediately. You're prioritizing getting the trade done, like now, over haggling about the exact price. So when is this the right tool to pull out? Well, it's pretty much perfect for highly liquid stocks. Those huge, well-known companies where millions of shares are trading every single day. In those situations, the price is usually pretty stable, so you can be confident you're going to get a fair deal. This is your go-to when you've made up your mind. You don't want to miss the boat, and you're totally okay if the final price is a few cents different from what you just saw on the screen. And this really gets to the heart of the trade-off. With a market order, you get guaranteed execution. That deal is going to happen, and it's going to happen fast. But what you're giving up is total control over the price. The market moves in milliseconds, so the price you actually get might be slightly different than the one you were quoted a second ago. For most long-term investors in major stocks, that's a trade-off they're willing to make. But what if price is your number one priority? What if you have a very specific number in your head and you are not willing to pay a penny more? Well, for that, we need to reach for our second tool, the limit order. This is your precision instrument. A limit order puts you firmly in the driver's seat when it comes to price. You're telling your broker, look, I want to buy this stock, but I absolutely refuse to pay more than this exact price. Or if you're selling, it's I will not accept anything less than this amount. It is all about control. So when does a limit order really get to shine? It's perfect when you want to control your exact entry point. It's also a total lifesaver for less liquid stocks, where the price can sometimes swing wildly. A limit order protects you from getting caught in a sudden price spike and accidentally overpaying. You could say this is the tool for the patient investor, the one who's not in a rush. But here's the flip side of that coin, the other side of the trade-off. You get a guaranteed price, which is fantastic, right? The catch? There is zero guarantee of execution. If the stock's price never actually drops to your limit, your order is just going to sit there, unfilled. And that's a real risk. You could miss out on a fantastic investment because you were holding out for a price that just never came. Okay, so we've covered buying, but what about protecting your investment after you already own it? For that, we need our third tool, and this one acts like a financial safety net, the stop-loss order. Think of a stop-loss as a preset emergency exit. It's this dormant order that you place with your broker. It just sits there, does absolutely nothing, until the stock price falls and hits a specific stop price that you've chosen. The second that happens, it instantly becomes a market order to sell. Its main job? Risk management. It's there to limit your potential losses. So let's just walk through how this works. Let's say you buy a stock at $50. To protect yourself, you go ahead and place a stop-loss order at $45. The stock does well for a while, but then some bad news hits and the price starts to fall. As soon as that price touches $45, boom, your stop-loss order is triggered. It instantly converts into a market order, and your broker sells your shares at the next best available price. But there's a really crucial risk here you need to be aware of. Stop-loss orders can absolutely protect you from big losses, but they can also be triggered by just temporary market craziness. A stock can have a quick, sharp dip and then recover just as fast. If that little dip happens to hit your stop price, your shares are sold automatically, and you could completely miss out on the rebound. You might get kicked out of a great long-term investment just because of a short-term market hiccup. So there we have it, our three main tools: the market order for speed, the limit order for price, and the stop loss for protection. Now let's put this all together so you can see how to really master your new investor's toolkit. This table right here, this is basically your ultimate cheat sheet. If your goal is simply buy it now, then the market order is your tool. It guarantees execution, but you risk the exact price. If your mantra is buy it at my price, you're going to use a limit order. It guarantees your price but risks the trade never actually happening. And if your primary thought is I gotta protect my investment, the stop loss is your go-to. It gives you an automatic trigger to sell, but you risk being sold out on just a temporary dip. At the end of the day, these aren't just some abstract order types. They're the actual tools you use to build and manage your portfolio based on your own strategy, your own goals, and your own comfort with risk. Understanding them means you're no longer just a passenger, you're the architect. The toolkit is now yours. So the only question left is, what are you going to build with it?